makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. Actually, I'm not in London. I'm in Paris, and because we had a great New Voices program, here's what's coming up on today's show. Indian stocks, bonds, and the rupee slide as early results point to a narrower than expected win for Prime Minister Modi. Ahead of the ECB decision on Thursday, some investors are dialing back their rate cut expectations for the year on strong economic data. Plus, Intel fires back at Nvidia over its claim that traditional processors are running out of steam in the age of artificial intelligence. So good morning, everyone. There's a lot going on in the markets today. Let's first of all look at the European markets map, but actually the big surprise is what's going on with Indian assets. Now, a couple of things that we should alert you to. First of all, expectations in terms of ECB cuts have shifted slightly. European stocks a little bit under pressure. Again, investors seem to be weighing concerns about the health of the U.S. economy against some stronger expectations for early Fed policy easing. So I'm looking at the CAC 40 here in Paris, down 0.5%, as is the FTSE MIB and the UK. But the other very big, of course, spotlight is India, where the country's stocks, but also the currency and bonds are all dropping. And this is on initial ballot counting, signaling a narrow victory for the Prime Minister Narendra Modi. And this means that some of the things that have been put in place, for example, the cutting of red tape, could come into question. You can see the MSCI India index down 5.9%. So we keep an eye, of course, on what's happening in India and look at the way forward. Again, it's a stunning result after exit polls that showed that he was on pace for a landslide victory. So this is Mr. Modi. We look at some of the policies in place and, of course, what this means going forward. So the slimmer than expected victory for Narendra Modi's alliance will raise questions about the new government's ability to push through difficult reforms in land and labor laws, an agenda seen as crucial by some investors to sustain India's economic growth. So let's get more now from Bloomberg's South Asia economy editor, Rushi Bhatia. Rushi, I mean, this is a huge, huge surprise. What are the key numbers to watch for as counting continues in the next few hours?
Hi, Francine. Absolutely a big surprise coming in. The exit polls have predicted a landslide victory for Prime Minister Narendra Modi. But so far, after nearly 5 hours of counting, we're halfway through the vote count, and the numbers show that it is a close contest between the Bharatiya Janata Party, the ruling dispensation, as well as the Congress party, the opposition-led Congress party. The BJP and their allies are still close to the 272 mark, which is the halfway mark that is needed for them to form the government. But it does look like that the opposition parties have given a tough contest this time around to the BJP. And, some of the issues that the BJP really took to the voters that have not really worked well for them. Also, the winning margins on several seats is very slim, and it goes to show that the opposition alliance's strategy to not contest against each other seems to have worked this time around.
So equity and bond markets are reacting pretty badly to this upset. I don't know whether it's because it was unexpected or actually they have real concerns about some of the reforms going forward.
Oh, absolutely. As far as reforms are concerned, it does look like that Narendra Modi's BJP will find it very tough, because every time in India we've seen if a coalition government comes in, then it becomes very hard to push through critical reforms. Even when the Bharatiya Janata Party in the last two polls, when they had a big majority, they were not able to push through critical reforms like land, labor and the farm sector reforms. Besides that, it is quite likely that the new government will have to give in to the demands of the allies and will have to push through welfare policies, because we do see a wide rural distress in the country, and that would mean some sort of a slippage on the fiscal numbers as well, and that will not be seen very well by various economists and analysts. Remember, S&P has recently said that India is on the watch for a ratings upgrade, and if India falters or widens its fiscal deficit going forward in the next budget, that is in July, it is quite likely that the rating agencies will certainly not like it.
Rupee, thank you so much. The biggest story today, of course, it's what happens next and some of the reforms as we continue counting and looking at news from the counting of the votes. Rupee Bhatia there looking at the Indian elections. Now, robust economic data in Europe and vocal ECB hawks are also pushing some to waver in their expectations for interest rate cuts this year. Well, joining us now is Elise Badoy. She's head of EMEA equity research at Citigroup. Elise, as always, thank you so much for coming in. There's a lot of focus on what happens with the ECB on Thursday. It's widely expected that they cut. But has the market been too presumptuous that once they cut, they continue cutting almost at every meeting?
Morning, Francine. Well, we've recently reined back our expectation for sequential cuts, and we now expect the ECB to cut this coming Thursday and then subsequently probably now in September. What our economists are really seeing is an environment where there's no particular, actually, and it's an unusual environment, there's not particular pressure for the ECB to act in a certain direction. Inflation is now looking like it's moving in the right direction. Financial markets are behaving properly. And obviously, we've got a number of other factors. The geopolitical scene is very active, although not very, very reactive. But I think the most important perspective from our economists lately is they have actually upped a little bit their view on terminal rates from 1.5% to 2%. So that means slightly higher rate for longer, which we think is actually not necessarily a risk or a negative for the European equity market. In fact, we believe that could actually be a paradigm or a setup for equities to perform.
I was going to ask you, Elise, what does that mean for actually, I know you have been very constructive on equities in Europe, but does it remain the case? And do your targets change? So over the next, essentially, we've seen obviously a strong rally for European equity market, but that's been synchronized with the rest of, with equities in general. What we believe is longer term, we might actually see a different environment for European equities specifically. So pre the global financial crisis, we were in that environment where you had, higher inflation or slightly higher inflation, more around 2%, and we had slightly higher rates. And this is an environment that actually has seen European equities not being this sort of serial underperformer that we had seen. Now, obviously, I'm conscious that, over the last few months, we've had a relatively interesting European equity rally. And in fact, we've seen in the last months, for the first time in 12 months, inflows into European equities. And actually, we are constructive over the next 12 months. We have a balance of risk. We still have some risks. But I think longer term, some of the sectors that make up the European equity markets, like, for example, financials or industrial cyclicals, are sectors that tend to do well with actually slightly higher rates and slightly higher inflation than the sort of zero rates or very, very low inflation environment we had prior to the shocks that we've seen. So, Elise, how do you build a portfolio? Like, how much is it weighted towards cyclical stocks and industries?
So currently we are overweight, for European equities specifically, we are overweight cyclical stocks. So we are overweight essentially tech, base materials, and also industrials. Probably not autos at the moment, particularly because we're seeing a lot of competition, out of China. But that's for the cyclical end of things. We would favor those three subsectors. And then obviously, should you want some exposure, slight exposure to defensive, we would favor healthcare as our favorite defensive play.
Elise, I know you've also identified three risks or catalysts, and you mentioned China. You've mentioned, of course, geopolitical risk and the fact that there's always a danger that interest rates stay higher for longer. Is there a danger? What's out of these three the biggest danger, actually, that could move around in terms of targets and expectations?
Actually, the largest, the largest risk we see is at the moment we have, we don't have any external shocks, and external shocks are the biggest risk we see. So particularly supply chain risks that, that we could see. So geopolitical risk, etc., via obviously the communication mechanism of oil are some of the risks that we could see from the outside. But in terms of as far as the market is going, we are right now. We won't have much fundamental news. We'll have that at the H1. We've seen margin holding up, a very good set of Q1. If we sort of ease into that going into the summer, we could be more constructive on EPS growth. At the moment, we're forecasting 6% bottom-up EPS growth, and we could see that consolidated after the H1 results.
Elise, talk to me about margins. I know you put out a very interesting note looking at a breakdown of some of the European companies or sectors and what kind of margins we can expect. Again, is there a valuation play between US equities and European ones?
So obviously, the key question from investors at the moment is constantly around margins. And that's because we have inflation that actually is receding. And usually, margin tend to move with inflation, i.e., if inflation recedes, then you tend to lose that gain you had from higher sales, and those better margins tend to recede with actually receding inflation. So that's a valid investor concern based on history. What we've seen actually is really good margin resilience. And we anticipate that that's likely to continue and be confirmed as we head into, the half-year results. By sector, how that looks like is, you do have some sectors that have perhaps been challenged in the past that might actually come out better. Again, something that would actually favour cyclical plays and particularly industrials.
Elise, when you look at politics, and it's very difficult, for example, to see some of the policies really in place that will come out of the U.S. election, depending on who's in the White House. But again, is there a danger that actually inflation, there's an uptick because of geopolitical tensions, but also maybe because of protectionist stances that could come in place?
I think I link that's the key question, and obviously that's linked to the view of our economist. What actually is the premises of our view for higher rate for longer is this perspective of, of the fact that both energy transition, but also geopolitical, what I might call geopolitical transition to a world where security is very important to policy. Obviously, that is inflationary, right? And from that perspective, that's where we end up in Europe, which is highly exposed to the US, with a higher terminal rate of 2% versus 1.5% that we were previously forecasting. That's based on the premise that the world we live in could be slightly more inflationary for longer. Now, obviously, that doesn't come as a straight line, and that tends to come more as a shock to supply chain. And obviously, from an energy transition perspective, that could come as a supply chain shock, for example, with a climate change event. But also it comes with policy, with, this view that we have to be, obviously here in Europe, we have an election in the UK. And one thing that actually isn't controversial is, I think, the view is that everyone, both sides agree that we should probably have more spend on defense. And I think that that's an unusual setup, which, in the past, it was more bipolarized.
Elise, as always, thank you so much for coming on. Elise Badoy, they're head of EMEA Equity Strategy at Research at Citigroup. But thank you so much for joining us. Plenty more to come, and this is Bloomberg.
We have a long-term relationship with Paris because we've been here for more than 70 years. But to your point, we multiplied by 9 or 10 our headcount here. And that happened post-Brexit, right? We wanted to turn Brexit as a necessity to a massive opportunity. And the view was to serve our European client from France. So that was our decision. So there's no plan to grow at that pace in the near future. But I think what is key here is we want to adapt and we want to evolve with our clients. So depending on our client needs, depending on the market environment as well, we will grow, to certain products, certain asset classes, and certain area. We want to make sure that we deliver the full scope of product to our clients and to offer the best services. So it's all depending on our client needs and evolve with our clients.
Okay, I have to be a little cheeky and just sort of ask, like, when you say incremental over the next 2 to 3 years, what is incremental? Is it a couple dozen in that period or a couple hundred? What does incremental look like?
It's more than a couple dozen because already for this year we have planned to hire more than that. But again, we have a big momentum here in France, a big momentum in Europe, and we want to make sure we follow that momentum, and actually sometimes we drive the momentum. So incremental means definitely more than a dozen, and we will add, over the next few years.
Well, that was Vanessa Holtz, the Chief Executive Officer of Bank of America Securities Europe, speaking at Bloomberg's New Voices event here in Paris. This is why we took the show on the road. Now, also at the event was the Chief Executive of Edmond the Rothschild, that's Ariane de Rothschild, and she told us that her firm benefited from the failure of Credit Suisse.
We manage our clients' money like we manage ours. So I think the myth of the amazingly solid bank was very harmful for the Swiss market.
So you've picked up business?
Yes. Yeah, and I think it's very interesting to see how very wealthy families have completely reviewed where they want to deposit their money.
That was the Edmond de Rothschild Chief Executive, Ariane de Rothschild. They're speaking to us at New Voices. We had a great conversation also about women in finance, which you can catch online. Now, coming up, Airbus is in talks to sell more than 100 wide-body planes to Chinese airlines. So we'll discuss that next. And this is Bloomberg.
Demand environment, I think, remains quite robust. It's recovering slower than we had expected, principally because of the Chinese market in terms of international travel to and from China. But I think that's a timing issue, not a plateau.
We're blessed to be in a region that is growing a lot. GCC is growing a lot. I mean, Saudi Arabia is growing a lot. The UAE is growing a lot. India is growing a lot. It's just 3 hours flight, right? Yep. So it's sustainable.
Right now, in terms of engines, we do not have that problem, which other peers or the industry is facing. In terms of aircraft delivery, of course, we face some delays, but which are manageable, I have to say. I mean, it's like several weeks for that.
In the supply chain, we are having trouble sourcing parts for interior cabins, for engines, that type of thing.
We're experiencing more severe turbulence, and we haven't had a significant incident yet, but we are taking all the precautions we need to keep the safety of our customers and our crew to the maximum.
Well, those were some of the airline executives who spoke to Bloomberg at the IATA annual meeting in Dubai. So let's stay with aviation. And Bloomberg understands that Airbus is in talks to sell more than 100 wide-body jets to China. Now, talks have gained momentum since President Xi Jinping visited his French counterpart, Emmanuel Macron, last month. Now, let's get more with Bloomberg's Sid Philip in Dubai. So, Sid, good morning. Why are the Chinese carriers looking to order new wide-body jets now?
Good morning, Francine. So essentially, all the airlines are looking to order wide-body jets because for all this while, we've seen a recovery of the narrow-body short-haul market. Now what we're seeing is long-haul travel is really coming back. And for that reason, airlines are really ramping up on ordering wide-body planes because during the pandemic, they stood down their fleets and now they're looking to replace them with more efficient aircraft as well as modern, more basically interiors and everything else. So we're seeing airlines ordering wide-body jets, and now the Chinese carriers are also looking at replacing some of their older jets that are coming of age and they've basically been in service for a while. And so the Chinese carriers are looking to replace those planes, and we understand that Airbus is in talks to sell them more than 100 A330neo aircraft.
So, Sid, how do geopolitical tensions actually impact the orders?
Yeah, so geopolitics obviously has a major impact on orders. I mean, Boeing is obviously trying to get into the Chinese market, but then They've also got issues with the geopolitics within the US and China. And at the moment, Boeing hasn't been able to deliver any aircraft to China because of a review by the Chinese aviation regulators into the batteries on a cockpit voice recorder. And that's sort of been a major blow for them because they just about started delivering planes again to China, and they've had to stop because of the review that's ongoing. So it is a massive blow, and essentially another bigger order for Airbus will be a blow for Boeing because they were hoping to get in more aircraft orders from China. But at the same time, Boeing's got its own bigger, wider issues, and they've got their whole supply chain issues. They've also been constrained in terms of ramping up production for the 737 MAX, as well as the production issues that they're facing on the 787. So they've got a big swath of issues they have to resolve, and this is one more issue for them.
Sid, thank you so much. As always, Sid Philip there in Dubai. Now, coming up, of course, don't miss our conversation with the Airbus and Boeing chief executives and the Berlin Aviation Summit to tune in from midday UK time. Coming up, Indian stocks tumble as early vote counts narrow than expected win for Modi. Indian stocks, bonds and the rupee slide as early results point to a narrower than expected win for Prime Minister Modi. Ahead of the ECB decision on Thursday, some investors are dialing back their rate cut expectations for the year on strong economic data. Plus, Intel fires back at Nvidia over its claim that traditional processors are running out of steam in the age of artificial intelligence. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris. Now, India's markets have slid as the early vote count suggests a narrower than expected victory for Prime Minister Narendra Modi. So for more on all of this, let's go straight to Bloomberg South Asia economy editor Rushi Bhatia. Rushi, thank you so much for the earlier update. I mean, if you look at some of the numbers as the counting continues in the next few hours, this could be a huge upset. Do we know about some of the underlying reasons why Prime Minister Modi is maybe less popular than we thought he was?
Well, absolutely right. Prime Minister Narendra Modi's ruling Bharatiya Janata Party was expecting a supermajority with almost 400 seats. In fact, the exit polls also seem to be suggesting that. But the results today, and nearly half of the votes polled have already been counted. They go on to show that it's a much tighter contest between the ruling Bharatiya Janata Party as well as the opposition-led Congress party. In fact, while the BJP and the Allies will still be getting close to the 272 mark and perhaps be forming the government, it does look like that the strategy that the opposition parties had of not contesting against each other seem to have played off. Also, remember, it is possibly because we did see local issues taking center stage. The fact that India's economy is growing at 8%, but still there is wide inequality. There is a lack of jobs. India is not creating enough jobs for its wide young population, and also the fact that high inflation seemed to have resonated with the voters, and perhaps that's the reason that we're seeing that the contest this time around is very close. It also goes on to show that the Hindu nationalist policies of the ruling dispensation perhaps have not worked in the way they wanted it to. A case in point being that Ayodhya, which centers the Ram temple, which got inaugurated earlier this year, there the Bharatiya Janata Party is trailing. So it does show that some of the local issues have gained center stage. The opposition strategy to fight in a cohesive unit seem to have worked well.
So if Modi's alliance is actually, has a tighter than expected lead, Rishi, what are some of the key numbers that we're looking for? Will most of the voting happen in the next couple of days? When will we have a clear picture of what this means for some of the reforms, especially in land and otherwise in labor markets that investors want to see pushed through?
As far as the results go, Francine, we are expecting that we will have a clearer picture by this evening. But as I said, the fact that the BJP is not coming in with a majority, they will need the allies to form a government. This will mean that some of the reform agenda that Prime Minister Narendra Modi has so far talked about will be difficult. He will not be able to push through key reforms like land, labour, as well as the farm sector reforms. Even when Modi's Bharatiya Janata Party was in the government with a big majority, they were unsuccessful in pushing through with some of these reforms. So now it becomes even more difficult, which means that he will need more political capital to push through some of these critical reforms. Besides that, when you're forming the government with allies, you have to take into account their needs and wants as well, which means that perhaps more welfare related policies, and that would mean that the government may have to compromise on narrowing the fiscal deficit, which will not be taken up and which will not be seen very well by the rating agencies. Besides that, one also has to take into account that what will it mean for some of the policies that Modi talked about in the BJP manifesto, things like the Uniform Civil Code. He will not be able to push through on some of these controversial, contentious issues if he's able to form the government with allies.
So do you think, Rishi, actually some of the reforms could actually be in question?
Well, yes, they will be in question. The broader policy, remember, Francine, will remain the same, because the broader policy, he will look to focus on pushing India's growth forward. India, from the 5th largest economy, is now closely moving towards being the world's 3rd largest economy. It is firmly on the path of 6.5% to 7% growth, but can it really punch above its weight? Can it really go to that 8% level, which is necessary to create the kind of jobs that India really wants, is something that one has to watch out for. Having said that, I must also tell you that the Indian markets are not taking it very well. The Indian stocks are having their worst days since the COVID crash in 2020. After heading close to the circuit breakers, we've seen some sort of a recovery kicking in, but the Adani Group stocks today have taken a massive beating.
Rishi, thank you so much for the terrific update. Rishi Bhatia there, of course, with the very latest from India. Now let's get more market analysis with Bloomberg MLIV strategist Ven Ram. Ven, it's been quite a wild day, actually, for a lot of these assets. In India, they seem to be a little bit calmer than they were 3-4 hours ago. What do you think happens next? And good morning, Ven.
Morning, Francine. I think that this decline in stocks was perhaps in the making. We wrote about 3 weeks ago, during the election period, that look, India's markets are too richly priced, and if the news goes awry, as it seems to have now, they will face a correction, and that's what's exactly happening. And I do think that we have not reached a full stop on that selling. I think that the Sensex will tumble about at least another 3% from here to 67,000 levels. We are not there yet. A lot of it will come down to the composition of the government and the kind of coalition that the BJP has to cobble together to form a government. Now, this is a huge upset for the markets that were pricing in outright victory for the BJP and its allies. That's fallen short, so the markets have to rework that calculus. I think over the long term, it's a different story, but over the short term, India's Sensex and the Rupee are pretty much vulnerable.
So then give me a sense of, if you look at some of the reforms, and Rishi was telling us about some of the land reforms, some of the labor market reform. I know, looking at the Nifty bank, there's more pressure on the banks, down 7% than some of the other ones, for example, the Nifty 50 at large. What do you think is at stake? What are investors worrying about the most?
I think, a key concern for the markets, Francine, will be what happens to the infrastructure push. Will Modi's new government be able to push through with that kind of infrastructure upgrade that they were planning earlier on? If you notice, some of the biggest stocks that have fallen the most today are the infrastructure stocks led by the Adani Group. So I think that questions, those kind of questions, markets will continue to ask those questions in the coming weeks, which is why I think that the Sensex has got a bit more to fall, and I think that it will take a long time for the markets to regroup and bid India stocks higher. And I think that will show on India's bonds as well. India's bonds, as you know, are due to be included in the emerging market, JP Morgan emerging market bond indexes. There have been huge inflows into India's bonds surrounding that. And the key question going forward will be whether those inflows keep up.
Ven, when you look at some of the bond pricing, how do they compare with other emerging economies?
I think that they are pretty richly priced, and I think that there's a good reason why they are meaningfully priced, because India has just won an upgrade, ratings outlook upgrade from the S&P. So that puts it on a path towards a possible rating upgrade, sovereign rating upgrade in a couple of years, which augurs well for stocks. The Reserve Bank of India is looking to cut rates at some point this year, albeit not immediately. So that augurs well for bond valuations again. And then there are those inflows that we discussed. Those inflows are likely to continue once we know that the BJP will be able to form a viable government in the centre. Once investors get past those concerns, I do think that those inflows will come back. So overall, the picture is quite rosy for bonds still.
Ven, thank you so much. Ven Ram there from our MLIV team, MLIV strategist there. Now, coming up, GameStop shares jumped 21% on Monday, adding some $1.7 billion to its market cap. So we'll discuss that next. And this is Bloomberg.
Europeans are heading to the polls to decide the makeup of the EU Parliament. On the ballot, economic growth and industrial policy, migration, and the geopolitical challenges facing the bloc. Stick with Bloomberg as we bring you the latest election updates from across the continent and analysis about what it means for the region and beyond. Tune in all week for continuing coverage leading up to the election results on June 10th. On Bloomberg Television, context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in Paris. Now, GameStop shares surging yesterday after the Reddit account that drove the meme stock mania in 2021 posted what appeared to be a $116 million position in the video game retailer. Now, the screenshot posted by Keith Gill showed a stake of 5 million shares. So let's bring in Bloomberg's Charlie Wells. Charlie, this is such a crazy story. Can the factors that propelled this week's GameStop rally keep going?
That's a really great question. I mean, look, this is certainly not 2021. The economic situation that brought the likes of meme stocks like GameStop, like AMC, are very different. But what I'm thinking of with this week's rally in GameStop is back to last month when Keith Gill, instead of taking to Reddit like he did this month, took to X to post a very cryptic message that looked like he was getting involved here. And that, again, translates back to this Reddit post where we saw this large position in GameStop. We saw also 120,000 call options here. Now, this is, propelling this rally, at least as of yesterday, but not a lot of fundamental changes at this company. So the meme rally, whether or not that continues, this phenomenon of social media investing, certainly here to stay.
So recent reports, Charlie, also show that E-Trade is considering kicking Keith Gill off its platform, at least according to the Wall Street Journal. What do we know about that?
This was a striking story. People familiar with the matter saying that inside E-Trade, which is of course owned by Morgan Stanley, people last month saw the account of Keith Gill make a large volume of options purchases before that tweet that I was talking about, before that tweet that drove that market rally. Now, the concern here is that this is market manipulation, and what we know is that no decision at E-Trade has been made about whether or not to kick Roaring Kitty, as he's also known, off of the platform. We know that the SEC is looking into market manipulation regarding GameStop, but there is a flip side to this, and the flip side is, a lot of these communications are vague. There's questions about whether this truly is market manipulation, but also if you kick someone with this sort of influence off a platform, you bring that army of retail traders potentially following and potentially leaving a platform like E-Trade as well.
Charlie, thank you so much. Charlie Wells there with the very latest on GameStop and other meme stocks. Now, Intel Chief Executive Pat Gelsinger has hit back at Nvidia in the battle for the AI chip leadership. Gelsinger says Nvidia boss Jensen Huang is wrong about traditional processors running out of steam in the age of artificial intelligence.
We look now to have 1 billion transistors on a single chip, and even looking to 1 trillion transistors in a single package by the end of the decade. And unlike what Jensen might have you believe, Moore's Law is alive and well.
Well, let's bring in Matt Bloxham from Bloomberg Intelligence. Matt, good morning. So does Intel have actually what it takes to challenge Nvidia on AI chips?
It's a good question. I think it's going to be a really interesting rivalry that unfolds over the next couple of years. I think if you think about Nvidia's dominance in AI chips, it's around the data center, and its biggest customers by far are these big so-called hyperscalers, people like Google that run the big data centers. Now, obviously, the growth opportunity for generative AI is around enterprise use of that. Nvidia has talked about that a lot as a kind of incremental revenue opportunity. This is clearly where Intel has historical strength, both in terms of kind of processing, but also the server market. So I think it's going to be a real kind of clash of chip titans, if you like, going into the next 2 or 3 years. And obviously Intel's pushing this as a combination of being faster and cheaper. So they're kind of matching their new Gaudi processors up against the Nvidia H100s, which is the current generation of Nvidia chips, soon to be replaced by their Blackwell chip. So they're kind of going for the look. If you're thinking about the H100 from an Nvidia, then this new Intel processor is going to give you better performance at a substantially cheaper price. So they're talking about maybe up to 2/3 less of the cost of an equivalent Nvidia platform. So it's going to be an interesting time to watch how this evolves.
So, Matt, give me a sense of what happens in 12 months, 15 months, 18 months. How do you see this rivalry evolving?
Yes, obviously right now the focus is on these kind of data center AI chips, but the rivalry is probably going to shift towards the PC market too. Now, it's obviously where Intel has a lot of historical dominance, but there's been rumors for quite some time that Nvidia is exploring the opportunity to develop its own AI chips. Those rumours have been growing louder and louder in recent weeks. Even companies like Dell that partner with Nvidia suggesting that Nvidia could be getting into that market. Some stories over the last week providing more clarity about what that kind of chip proposition might look like. So I think clearly over the next 12 to 24 months, the data center AI processing rivalry is going to heat up, but then we're going to get this extra dynamic in the AI PC market probably in 2025. So Nvidia is protecting its space, developing its technology, and part of that is the defense saying, if you enter to Intel, if you enter my space, I'm going to push back into your space too. So you're going to have a really interesting, multifaceted rivalry, I think, in the next 2 to 3 years.
Matt, thank you so much, as always, for joining us. Matthew Bloxham there from Bloomberg Intelligence. Now, coming up, we talk about the UK and the UK Prime Minister Rishi Sunak being dealt another blow as Brexit architect Nigel Farage says he will stand in the general election. That story is next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in Paris, where we were here for the New Voices program. Now, onto politics, and the Conservative and Labour leaders will go head-to-head in the first TV debate of the election this evening. But whoever wins the vote on July the 4th will be saddled with an economy laden with debt after 4 years of crisis spending. Well, Bloomberg's Alice Morgan explains.
The photo ops are in full swing as the UK general election kicks up a gear. But whoever wins that contest will face a harsh truth. The UK has a massive debt hangover, and that threatens to tie the hands of the next government and to collide with spending pledges on things like defence, healthcare and education.
The UK spent big during 4 years of crises, from COVID to the energy price spike following Russia's invasion of Ukraine. Government support measures during those successive disasters cost around £400 billion. Both parties supported taking a generous approach. Now, though, the bill has come due. with national debt at a level not seen since the 1960s. Servicing that debt in a world of high interest rates is costing an extra £60 billion a year. To put that in perspective, that's equivalent to the entire defence budget without a bullet to show for it. And now creaking public services are crying out for more funding, with much desired economic growth seeming elusive.
Well, the election debate so far has really been focused on how the parties are funding relatively small pledges on taxes and spending. But this misses the far bigger picture of an unprecedented peacetime rise in debt, rising taxes. What's really happened here is that the fiscal debate has got detached from that fiscal reality.
Rishi Sunak claims the economy has turned a corner, with inflation falling back near the 2% target.
Thank you.
Meanwhile, Labour are on a mission to assure business that they are the party of economic stability. Regardless, the UK faces a mounting bill with no easy way to pay it off.
Now, staying with the UK election, Brexit cheerleader and populist Nigel Farage says he will run for Parliament days after ruling himself out. Now, he'll stand as a candidate for the Reform UK party, as well as taking over its leader. Well, joining us now is Bloomberg's Ellen Milligan. Ellen, good morning. So why is Nigel Farage's return so critical for the Conservatives?
Well, as Nigel Farage himself said yesterday in his so-called emergency press conference, he wants to lead a political revolt this election and afterwards. So he's running in a seat in Essex, and this is all about squeezing the Conservatives. So from the left, you've got the Labour Party, and now from the right, you've got Reform led by Nigel Farage. Clacton in Essex was a seat that was won by Farage's old party, UKIP, in 2015, so it's winnable. But it's also about influencing Conservative Party policy and swinging them to the right. So, for example, hours after Farage announced he was standing, Rishi Sunak announced that he would place a cap on immigration visas, for example. So you're already seeing the effect that Farage is having.
So, Ellen, the Prime Minister Sunak is attempting to open this clear divide with Keir Starmer on immigration. So what exactly is he pledging?
Yeah, well, he's announced that he wants to introduce an immigration cap. He hasn't put a number on it. Labour Party, Keir Starmer, has announced that he wants to reduce immigration. Again, hasn't put a number on it. So I think at the TV debates tonight, you'll really see them going at each other on their kind of quite thin immigration policies. But also my colleague Alex Wickham reported today that the Conservative Party is considering a more hardline position on the European Convention of Human Rights. This is the court that's involved in the Rwanda bill, for example, that the right-wing Conservative Party complains is disrupting UK legislation. So I think that will be really interesting if that's created as a dividing line also.
Ellen, thank you so much. Ellen Milligan there with the very latest on the UK. Now, I have had a couple of traders actually email and get in touch saying what we've seen and the upset that we've seen in India with the fact that Modi's coalition has a narrower, for the moment, as votes keep on being counted, a narrower than expected lead. What does that mean for the UK? Because yesterday we also had mega polls that were published in the UK that had Labour actually winning by at least 20 points. So there is a little bit of question mark whether some of the polls, and again, the parallels between India and the UK system are very different, but there are a couple of questions on the market about what it means. Now, because of this narrower than expected, of course, lead by Narendra Modi, you can see the MSCI India index down 6%. Up next, Bloomberg Brief with Manus Krani in New York. This is Bloomberg.